So we're going to take a look now at how monetary policy can be enacted through the purchasing of bonds, and more specifically how it has an impact on the macroeconomy through interest rates. So we're back at our hypothetical economy here, and what I want you to take a look at or notice is that our hypothetical economy right now is at equilibrium on the long run average supply curve. So this is where we're at currently. Let's say that we wanted to change this position though for our economy, that we wanted it to, instead of intersecting perfectly on the long run average supply line, for some reason as a Federal Reserve, we wanted to enact monetary policy that would stimulate it and cause it to expand. So let's demonstrate expansionary monetary policy. Now, from what you understand of expansionary monetary policy, it starts typically with a recessionary gap, but let's pretend that right now we are not as concerned about closing a recessionary gap as we are of trying to stimulate the economy past its long run potential output. What would typically happen then is that the Fed would buy bonds, right? And in buying bonds, we would hope that that would increase the money supply, shifting the supply curve to the right. And by doing that in the money market, it would reduce the interest rate. And at the same time that it reduces the interest rate, that should stimulate aggregate demand, but it would also cause the exchange rate to fall. So let's see. Let's take that step by step. Buying bonds in the economy, right? So the Federal Reserve has a few tools to buy, to change interest rates, and they largely involve buying assets or selling assets. Let's say that we want to go with a simple version where the Federal Reserve just adjusts its federal funds rate, with the hope that adjusting the federal funds rate, changing it from its current 2.16 level and reducing that will actually stimulate more growth in the economy. To do that, in our theoretical economy, we will go to our yield curve control here, and we see that the federal funds rate is one of the areas that is in dark, so it's influenced by C32, and that's because the federal funds rate in our modeled economy reflects the fact that the Federal Reserve basically tries to guide where the federal funds rate will be. They don't have direct control over the federal funds rate, so they're trying to guide it towards a target. Let's say, for example, that the federal funds rate we wanted to target, instead of being 2.16 on average, we ended up wanting to target something closer to 0.25. What we're going to do is enter into here 0.0025 actually, to reflect that as a whole number we want this to be 0.25%. Hit enter, and what you see is that the impact on our macroeconomy is interesting. First, shifting over here, you can see that now the economy intersects somewhere to the right of the long run average supply curve. This should have been expected, because what we understand is that this dropping of the interest rate should stimulate the economy. But I want you to also appreciate the change to the Federal Reserve's balance sheet. So the Federal Reserve has to reduce interest rates by buying bonds, which means that they're pushing cash into the economy. But they're also buying assets. Those bonds are actual financial assets. So they're actually increasing the size of their balance sheet by printing cash, and in exchange for that cash that's been printed by the Treasury and given to the Federal Reserve to use for this program, they are now taking on these bonds that the banks in the economy had before. So the Federal Reserve's balance sheet actually increases, in this case by what I believe is $189 billion. Now remember, this economy is hypothetical, so these numbers aren't going to be precise. It's really the direction of the change that we should be paying attention to. pay attention to and appreciate that the balance sheet increases by several $billions in an effort to try to reduce the economy's interest rate. In return for that, though, the Federal Reserve changes the money supply, adds to the money supply by about $985 million. This reflects what we were discussing before, right? As the interest rate goes down, because the Federal Reserve is buying bonds, they're also pushing cash into the economy. And you see that cash being pushed in right now. So what is the effect on interest rates? Well, you can see that because the federal funds rate has now dropped to 0.25, we see that the 10-year Treasury in this example has dropped to 0%. I'm sorry, it hasn't dropped to 0%. We see that the 10-year Treasury in this example has dropped to the cumulative rate effect. This is common, we should be looking at, to 1.2%. So the 10-year Treasury was originally at 2.15. It's dropped now to 1.2% in this theoretical economy. The 30-year mortgage loan rate, which is the interest rate due on for anybody borrowing funds to buy a home and borrowing on a scale where the maturity date for their loan would be 30 years out from now, so they're borrowing over a long time frame. This is a further out maturity date. We see that that interest rate has dropped from 3.94% to 2.89%. These two drops reflect what we expect monetary policy to do for the macroeconomy. That if the Federal Reserve can control the federal funds rate target and bring that target down, it should have a ripple effect on other parts of the economy and bring down those interest rates as well. Let's scroll down a bit to see what this change in interest rate, what this reduction in interest rate has done to other aspects of the macroeconomy. On households, the lower interest rate should incentivize more spending from the households. And in our model, what we see is that household expenditures had originally started at $13.27 trillion, and they've gone up now from the lower interest rates to $13.926 trillion. This is after taking into consideration the multiplier, right? So the original change was from 13.279 trillion to 13.596, and then the multiplier that exists on the aggregate demand side multiplies the change so that the final change to GDP is $13.926 trillion in expenditures from households. Interesting. Of course, that comes from somewhere, so household savings reduce, but we'll take a look at that further when we talk more about the consumption side of aggregate demand. Firms should theoretically be spending more because their interest rates have fallen, and what we see is that yes, real gross domestic investment has increased from $3.421 trillion to $3.96 trillion, which goes through the multiplier to become $4.5 trillion. So we see gross domestic investment from firms increasing from 3.4 trillion to a final output of 4.5 trillion from these interest rates dropping. The final output for the economy, right, real GDP in billions of dollars, when we see in the short run, real GDP was looking at $19.045 trillion. The final component change is back to $19.045 trillion, but that is because we haven't actually adjusted for where the equilibrium lies now. So to do that in our theoretical model, I have to go through some adjustments here. I basically have to bring this back into equilibrium. So I'm going to use the goal seek in this in Google Sheets to do that, and I will quickly want to set the cell, which is this cell. All right, let's see. Set the cell. Target, perfect. Set this value to 0 by changing the price level, which would be for the cell. Perfect, awesome. Hit solve, and it will tell us finally where the balance lies for the economy in 2020. So we should see this number here change as I hit solve. It'll also tell us the equilibrium level of the prices in the economy, so the inflation rate. Let's see what the solve lands upon. So this error is not too unusual, but it probably got as close to zero as it possibly could. And I'm sure if we actually look over here and back at this tab, yeah, it basically got as close to zero as the difference between real GDP supply and real GDP demanded. What we see here is that the anticipated impact from the Federal Reserve cutting rates would be a amount of deflation. So it's saying that, again, the numbers themselves don't matter as much because this isn't necessarily calibrated to the complete reality of what happens in the US economy, but the direction of these changes matter. So it's saying that a cut in rates should lead to should have some deflationary pressure onto the economy. It doesn't mean that we would necessarily see absolute deflation occur, that we would see the dollar strengthen, because of course, right, there are going to be other effects happening at the same time. But if we were just to try to isolate the impact of the monetary policy effect of cutting rates, like we anticipate with the exchange rate, well, if we were to just isolate the monetary policy effects on the price level, the anticipation would be that because the rates are going down, theoretically prices are going to follow in that direction. You're going to see some level of deflation happening, but you will also see, on real terms, the economy's size increase. So while in 2019 we had this value of 19.072 trillion as real GDP in 2012 dollars, for 2020 in 2012 dollars we'll have a real GDP value of $19.695 trillion, an increase in real GDP resulting entirely from the effects of the Federal Reserve cutting the federal funds rate. Now, if you wanted to see what would happen on the opposite end, what we could do is increase federal funds rate from what was originally 2.16%, and let's see what happens if we were to just increase it to 0.04, which would be the whole number equivalent of a 4% interest rate. As you can see, the Federal Reserve asset balance sheet decreases. They end up selling off assets, which decreases the total balance sheet size. They end up pulling about around $949 billion of cash out of the economy. And what they end up doing to the rest of the interest rates in the economy is that they increase the treasury yield up to 3.07%, and they end up increasing the 30-year mortgage rate from 3.94% to 4.95%. And if we were to again hit solve on this to figure out what the equilibrium would be, what the impact would be from interest rates increasing, and if we look at the aggregate supply curve, you can kind of get aggregate supply, aggregate demand, you can kind of get an idea that we would be in a contractionary environment. What we see happening is getting as close to an equilibrium solution as possible. Yeah, again, I'm pretty sure it got as close to the equilibrium solution as possible. What we end up seeing is hypothetically an increase in inflation of nearly 5%. And a decrease in the real size of the economy from $19.072 trillion to $18.206 trillion. So this was to illustrate to you what happens when the Federal Reserve changes interest rates, right? The idea here is that increasing the interest rate should contract the economy, that it would be contractionary monetary policy, as opposed to what we had first ran, which would be considered expansionary monetary policy, both of which are enacted by the Federal Reserve using the tool that they have of open market operations to buy and sell bonds. There are some other tools being proposed that you could possibly see the effects of here. If I was to bring this back down, let's just bring this back to 0.0216, back to where it originally was. For example, the Federal Reserve has in the past used quantitative easing, which would be the equivalent in this hypothetical model of buying 30-year mortgage loan rates. So if the Federal Reserve already brought the federal funds rate down to zero, for example, and still wanted to stimulate the economy even further, they may buy 30-year mortgage loans from the rest of the economy and try to increase demand for those to bring the price up even further and bring the interest rate for it down even further. So let's say they even brought this down to 0.0. Oh, let's see, we got a percentage down here. So let's say 2%, right? Bring this down to 2%. The cumulative effect of the mortgage loan rate dropping down to 2% and the federal funds rate being at 0% would bring the mortgage loan rate down to 0.81%. But look what our quantitative easing has done. It's also increased the size of our balance sheet and added even more money into the economy than was originally there. So if I undo the effect of changing that mortgage loan interest rate, right, the money added to the economy was just 1.1 trillion. We add that, it's now at 6.3 trillion. On top of that tool, the quantitative easing tool, which was very popular in the wake of the Great Recession, once the Federal Reserve brought interest rates down to zero and had to figure out another way to kind of push down the yield curve. And again, I want to show you what the yield curve looks like in this case. It's like, oh, look at that. The yield curve has this big spurt in the middle at the 10-year point. Maybe we see that and we want to bring down the 10-year side as well. Well, there's something now called interest rate pegging, which the Federal Reserve is debating and looking into, which has been tried by other monetary policy folks. If I'm correct in my remembering, I think it had been tried by the Bank of Japan. Interest rate pegging, if the Federal Reserve wanted to try to peg the interest rate for the 10-year close to zero as well. So instead of 2.15%, let's say we want to make this 0% as well. The cumulative effect of all of those leads to a 10-year that goes into the negative, similar to the negative interest rates we had talked about in the past, and a 30-year mortgage that also drops into the negative range as well. So what we have done through accumulation of monetary policy effects is that we've brought this yield curve down well under the 0% range. We have very much so stimulated the U.S. economy here, or theoretical economy here, and we have injected $10 trillion of money into the economy while changing our asset balance sheet by $1.9 trillion. Let's see what the cumulative effect of all of this would be on the size of the economy. Oh, we got an actual solution. Oh, that's amazing. All right. And the solution is that we see immense deflation occur. We see the economy expand by over 1 trillion, nearly $2 trillion. And cyclical unemployment is clearly at 0% because who would be unemployed when, at least based on the business cycle, who would be unemployed by business cycle influences when the economy is stimulated to this level? Yeah, you can see long run, like aggregate demand and short run aggregate supply curve are intersecting well below a flat price level. So there's definitely deflation occurring and there's definitely expansion occurring in the economy. So that's it for covering some of the monetary policy side effects. Hopefully this illuminates a bit more about what the Federal Reserve's tools are, what they can do, and how their changing of these interest rates can impact the rest of the economy.